Hi, this is Kevin from Excel Coaching. I'm sure you are here to learn more about the balance sheet. So let's get onto it. What is a balance sheet? A balance sheet shows the financial position of an organization as at a particular date. It shows the net worth of a business, disclosing the assets and liabilities. On the right hand side of my screen, I have the balance sheet for BHP. And as always, we'll use some real examples and numbers to explain these financial concepts or terminology. So, what's an asset? An asset is defined as a resource controlled by an entity as a result of past transactions or past events from which future economic benefits will flow. There are three essential characteristics of an asset. Number one, control. Number two, it has to be as a result of a past transaction. And number three, it needs to generate future economic benefits. Some examples of an asset are land and building, machinery, inventory, or your cash balance. Very simplistically, assets are what you own. Liability. What is a liability? A liability is defined as a present obligation arising from past events which will result in an outflow of economic benefits. The three important elements here are reduction in economic benefits, a present obligation, and as a result of past transaction. Think of a financial debt. If BHP takes a debt from a financial institution, there will be a reduction in the future economic benefits. That is, there will be a reduction in the net worth when BHP repays the interest and the principal. There is a present obligation because contractually BHP owes that money. And the third element is past transaction or past event, which is when BHP took the debt. Examples of liabilities are debts, accounts payable, tax liabilities, and so on. Think of what you owe. The balance sheet shows the net worth of an organization, which is effectively the equity. Equity is defined as assets minus your liabilities. In the equity section, you will have the original contributed equity or share capital, any reserves, retained profits from prior years, and current year earnings. In this example, the assets for BHP were worth $100 billion. The liabilities were $49 billion. Therefore, the equity is 100 minus 49, which is $51 billion. Ideally, the firm's balance sheet shows an accurate assessment of the company's net worth. Unfortunately, this is unlikely to be the case. Let's look at some examples of why the equity figure may not give us a true reflection of the business net worth. Think of land and buildings. What the balance sheet will show is the original costs less any accumulated depreciation. But the market value of that land might be a lot higher. Another example, all the stock or inventory is valued at the lower of costs or realizable value. That is, it may not include the full margin the company may be getting from selling the stock. There may also be valuable resources like the quality of the management team, the strength of the staff, good suppliers relationship, which are not recorded on the balance sheet. How about the value from future projects or growth opportunities? For example, PHP may have plans to expand some of its current production level and make more money. None of that is reflected on the equity number in the balance sheet. It is critical for an organization to review the health of the balance sheet periodically. This important exercise can highlight potential risk or deficiencies in the accounts. I have listed some examples of risk on the balance sheet here, but feel free to comment or reach out if you wish to discuss this area further. In this recording, our objective was to explain what the balance sheet is and some of the various terminologies associated with the balance sheet. I trust you have enjoyed it. The next recording in this series will focus on the cash flow statement. I look forward to be interacting with you very shortly.